Hello, thank you for joining us today. We are thrilled you're here. This topic is very important, and the National Bicycle Dealers Association is proud to partner with Red Bike Advisors to bring today's webinar 5 finance topics that every small business owner should master. With 82% of small business failures due to poor cash flow management, it's no wonder that this is a topic that might cause us to lie awake at night and have a lot of stress if we're going to make payroll, if we're going to cover our operating expenses. We're really focused on making sure that every single NBDA member, every single bicycle retailer is seriously focused on sustainable growth, making sure you understand your finances and that you have resources available to you. We partnered with Red Bike Advisors earlier this year, and Gretchen Roberts and her team are 100% committed to making sure that they're a resource for all NBDA members. I'm thrilled to have Gretchen Roberts here today, and I'm going to turn it over to Gretchen. As we go along today, if you have questions, please use the chat function or the Q&A. If the question is relevant to the topic that Gretchen's talking about at the time, we'll address that live, and if not, we'll hold questions to the end of the presentation. Gretchen, thank you for being here.
Thank you so much, Heather. It's really good to be here. Thank you, everybody, for showing up for this topic. I realize finance can be kind of a snoozer, but it's great to have you all here. And I will try to make this as lively as possible because actually this gets me super excited. So let's start with a little bit about me. Like you, I am a business owner. So I am the CEO and owner of Red Bike Advisors. We're an accounting, tax, and forensic accounting firm based in Wilmington, North Carolina. I'll tell you a little bit more about us in a little bit, but me personally, I am wife to an amazing husband named Derek. We have 4 kids and one adorable mini golden doodle. His name is Oakley. I hope he doesn't make an audio appearance on our webinar today because he is sitting right next to me. So hopefully the UPS guy won't show up. And then when I think about, what do I stand for and what does my firm stand for and what do we really show up every day to do? For us, it's that we're on a mission to help business owners know your numbers and grow. Small business is hard. I think all of you can raise your hand to that, right? And so you're constantly dealing with different things. And, we feel like we can partner with small business owners and really help you know your numbers, stay sustainable, and hopefully grow and maybe exit if you want to. All right, so let's talk about some of the stuff going on in the macroeconomic environment, just as a starting point, right? So these things are totally unpredictable. They're mostly out of our control. I think everybody's aware of the runaway inflation. It does seem to have slowed down a little bit, which is great. But, I don't know about you, but last time I was in the grocery store, it was like, whoo, that's a big bill, especially with teenagers. Interest rates, if you're trying to get a business loan, trying to get a home, it reduces your buying power, right? Because the interest rates are so high right now. Compliance is constantly changing. We have a new thing that the government has mandated called BOI reporting. I don't know if you've heard of that, but it's just one more thing that is coming out, in terms of compliance. And it kind of falls to me in that box of things you wish you didn't know and maybe don't know, but probably should, right? Compliance stuff is constantly changing, whether at the state, local, or federal level. Literally all of our clients talk about how hard it is to hire people right now. I think everybody's been feeling that squeeze since COVID. I'm guessing you're no different. Weather events. My husband and kids are actually in Western North Carolina mucking out like this much mud out of, some different homes and places in the mountains over there, and we've got hurricanes coming through all kinds of places in the Southeast. I'm sure some of you were or know people who were impacted by those, and we can't control those things, right? And on the right side of the column is probably a little bit less retail oriented, like remote work, but it has impacted a lot of the patterns that, we have in our society. AI, cybersecurity, data, all those techno things that you don't know if you should adopt now or wait and see if the bottom falls through, right? Inventory problems. That was a big thing during COVID. I think that's starting to get better. But again, this is the stuff that's out of our control. And so, we could spend time worrying about this stuff, or we could say, okay, so I want a healthy, growing business. I want to have that no matter what's happening in the macroeconomic environment. So then you have to ask yourself the question, what is in your control? And the short answer, which is what we're going to talk about today, is knowing your numbers. Okay. All right. So Heather already read this stat off. This was kind of my promo stat, but I think it's really important, right? 82% of small business owners fail because of poor cash flow management. What does that mean? It means you could have stellar service, an amazing location, sales through the roof. You could have everything going for you. But if you don't have any cash in the bank to pay your people and to pay your rent and to pay your expenses and to buy new inventory, you're out, right? So this is one of the most important things you can master as a business owner, because it's the number one business killer. Okay. Here's another one, just 31%, so a little less than a third of small business owners prepare financial forecasts regularly. This number is actually not surprising to me, because financial forecasts are what we'd consider to be a little bit more advanced than some of the stuff we're going to be talking about here today, but it is on the list. So I'll show you how you advance in your, your reading of financial documents to get to the place where you can do forecasts. So we'll talk about that a little bit. This one is very painful. Small business owners spend approximately 82 hours annually on tax compliance, and that's from the IRS. And if you think about that, is like 2 working weeks of the year. So there's a lot of time and effort spent on these things, right? So here's the question: what separates those businesses that thrive from those that don't survive in any economy, right? All right, so here's some fun stats. There's a 95% success rate for small businesses that look at their financial statements weekly. And what's interesting to me about this one is that we're not talking about forecasting or, having algorithms or predictive analytics. We're talking about reading your financial statements. That is the baseline, because once you read your financial statements, you start to see patterns. Once you start to see patterns, you can start making comparisons. Once you make comparisons, you can make decisions, right? So this is such a great stat, and I hope it's inspiration for you to go, hey, I should be pulling those QuickBooks reports more often. And here's another one: 82% of small business owners who experienced growth. So if you're looking to grow, they say that effective financial management is a key factor in that. Okay. It's really hard you can grow your revenue, but if your expenses get away from you in the process, we're back to the cash flow problem, right? So effective financial management is the key there. All right, so let's dive into our topic, which is 5 finance topics every small business owner should master. At a high level, we're first going to talk about cash, which is your company's lifeblood. And then we're going to talk about accounting, how to read financial reports. Please don't fall asleep or take a bathroom break during this one. Taxes, planning and projecting, right? So we want to plan and save for them, figure out what we need to do, and hopefully twist some levers and dials so we can save. And then the next 2 are a little bit more futuristic or long-term, right? The first 3 are probably things you're going to do on a regular basis, whether it's a weekly cadence, monthly, quarterly, annual, right? The next 2 are things that you can spend, your whole business career doing, right? Preparing, building a business that other people want to buy. That's your exit strategy. And then financial planning. So you're finally at that point where you have sound financial management, you're growing, you're making tons of money, you can't spend it all. What are you going to do with those earnings? All right. So let's get into it. We're going to start by talking about cash. This graphic, it makes me laugh, but it's also a place where I'm guessing a lot of you have been. So I don't know that I can see people raising their hands, but maybe you could just put it in the chat, and maybe Heather can jump in and tell us what people are saying in the chat. So put in the chat if you have been this guy sometime in the last year, you've been worried about cash or making your bill payments sometime in the last year, put it in the chat.
Yeah, it's a great question, Gretchen. And talking with our P2 members, which are our retailers who work with us, we know a lot of them. Cash flow and payroll, all of that has been a really important topic. Let's see what our attendees are putting in here. All the time is one of the, it's not funny, I hate to say that, but all the time is one of the first responses. Yeah.
Yeah. Let me ask you a second question, so you can also throw this in the chat if you have any comments, okay? How many of you check your bank balance Like just, you're grabbing that on your phone and you use that as a proxy for how you think you're doing.
Oh. Does anyone use your bank balance as a proxy?
Like how, can I pay my bills? Am I making any money? What do I got in the bank, right?
Yeah.
So
Yeah.
anybody responding to that one, Heather?
One that said if there's no money, so there's no need to check. So
Oh. Well, let's work on fixing that today. And by the way, so on the bank balancing, it is actually really good to check your bank balance. I check mine probably every other day. It's good to know what you've got in there, but it's not a proxy for the health of your business. So what you really want to look at is your cash flow, right? So you need to know what's going in and what's coming out, or else you're constantly living in a state of suspense. It doesn't matter what you have in there if you don't know what you're going to need it for, right? All right, so why is cash important besides paying your bills? It's also super important for growth, right? If you think about how you use cash, it is literally the first domino for every decision that you can make. Some examples, if you want to hire because you're growing, you need cash for that because that person that you hire is not going to be at 100% capacity right off the bat, right? So that's going to be an investment that you need to make. Need to buy inventory, you're going to need cash or some source of funds. You want to invest in R&D, research and development, you're going to need cash, right? Even if you get tax credit afterwards, you're running the cash for that. If you want to replace yourself and take some of the stress off, maybe hire a general manager or an executive assistant, you're going to need cash for that, right? And these are all investments that are related to growth. And so they're great, but you need the money to do it. So that's why cash is so important. Now let's talk about the difference between cash balance and cash flow, because I think people sometimes confuse these, and I'm hoping to break it down in a super easy way with my fake river AI graphic. Okay. So cash balance, you want to think of as like the nut, right? So it's the big boulder in the middle of the river that's roughly the same size all the time. You try to keep it at a steady place, right? So it's what you have in the bank right now to cover expenses at any given time. And then cash flow is looking at what's coming in and going out so you can manage your bills and those business decisions, whether it's, can I make payroll or do I need to put off a vendor, on one end, or on another end, what do I have to invest this quarter, right? So you want to make those decisions intelligently. Okay, so, let me know if you have any questions on that. And then we're going to talk a little bit about cash balance rules of thumb, and then we'll talk about cash flow rules of thumb, okay? So cash balance rules of thumb, and we're just going to pretend that we're starting out at square zero, right? So maybe it's the person who was in the chat saying there's no money in there, so there's nothing to really look at. So the first thing we recommend is that you build to an average of 1 month's expenses to start, okay? So if you're constantly less than that and scrabbling by with those, biweekly paychecks or however often you're doing payroll and paying bills and you're pushing things off and constantly having to do the rearrangement of what's due and when you're actually going to pay it, this is your first place to start. And so what that does is it gives you this nut so that you can make it through the month, right? Without lying awake at night. And how do you get that? What is the 1 month? Just go back a 12-month period, or you can go back to the prior year. You look at all of your expenses and then you divide it by 12, right? Pretty simple. That said, expenses do fluctuate, right? So they're not the same every month. And so that 1 month isn't going to be everything you need at all times. And so we'll talk about what the next step is. All right. So the next step is, if you have a line of credit, that's great. Everybody should have a line of credit because we all need something like that in case of emergency, right? But a line of credit should not be used to fund operating expenses, okay? The way I think of it, if you translate this to like your home life, let's say you're a W-2 employee and you get paid once a month, right? And so you get paid on the first of the month. Well, that previous month, you're funding everything on a high interest credit card that you're not able to pay off. And then your paycheck comes and you pay some of it off, but you're constantly in the wrong vicious cycle, right? And that line of credit, on the business side is funding your operations, which then you're trying to pay it down so you can fund the operations so you can pay it down. And meanwhile, you're paying interest on all that. And that's a really tough way to grow, right? So the next step we'd recommend is paying that down to zero ASAP if you're using it for operating expenses. Now, what should you use a line of credit for? It should be for emergencies. Things do happen, right? I mean, we just talked about the floods in North Carolina. That's and a lot of those people are trying to clean out all the muck and wait for their insurance companies to do something for them, right? And that's a pretty big emergency, but it could just be something like your star employee quit and you have to hire a very expensive temp. It could be anything, right? But that's what an emergency is. Your HVAC goes out. Fast turn inventory is another good way to use a line of credit. Some people who sort of lean on the Dave Ramsey no debt thing would say that's not a good use of it. But if you know your business and you know what inventory turns fast and you have a super good handle on what the timing is for that, a line of credit is not necessarily bad if you're crunching those numbers and seeing what your real profit is after you're paying off the line of credit. Investments, again, not operations. So investments, we talked about some of those. Maybe it's a new hire, maybe it's something else, something that's going to bring an ROI in, and you know what the timing will approximately be for that, so you know when you're going to be able to pay it off. Okay, so that's step 2, and then step 3 is, okay, now we got to get that cash balance a little higher so you can really sleep at night, right? And so the goal here is to build it to 3 months of expenses. Another rule of thumb that we sometimes use is 10% of revenue versus 3 months of expenses. So if you look here, you can kind of see what this looks like, right? So we'll just take this is a business. Let's say it's a retail bike store and the revenue is $1 million. Cost of goods and OpEx together is 900,000, and it's making about a 10% profit at 100,000, okay? So you take that 900,000 and then your 1 month of expenses is 75,000. Okay. 3 months. Whoa. Don't you just feel like you can sleep if you have this much in the bank to pay your expenses? And of course the number varies for everybody because it depends on what your expenses are. And then you can kind of see here the 10% of revenue, and it depends on what you're doing and and everything, but it kind of falls somewhere in between here. So if you're just like, gosh, I just really can't get it up to there, I don't want to have that much cash sitting around because I'm trying to reinvest it very quickly into inventory, this is maybe a good place to be, right? Because it gives you a cushion over that 1 month for those times when you have fluctuating expenses, annual prepaids, like maybe a piece of software or something like that, just jacks up your expenses that 1 month. Okay, so the next question here is, how on earth do you build that cash balance? We like to do something in the P&L, the profit and loss, called expense hide and seek. I recommend doing this every quarter, and at least you should be doing it annually. And now's a great time because we're in October, so we're in budgeting season. And so, there's basically 2 ways to build your cash balance, right? You trim expenses or you increase sales, right? So on the expense side, you should look at every single line item of every expense that you're incurring. Ask your team members, are you using this? I find that I'm often surprised when I do this exercise and I'll ask them, hey, are you using this super expensive piece of software? And they're like, oh, we haven't logged into that in months. I'm like, oh, well, we're canceling that one then. Or it could be something that that you think they need and they're not actually using, and you have to be realistic on that, right? Another example is, or another lens to look through it, I should say, is this bringing in a return on investment for me? Is it making me money? Whether that's direct or indirect, right? And if it's not making you money in a direct or indirect way, then perhaps it needs to be trimmed. You could also pay yourself less for a while you build that up, right? I don't recommend that if you are already paying yourself way under market, because you are the business owner and you should be paying yourself at market, right? And you should get a profit on top of that because you're taking on all the risk. But if you're paying yourself at market rate, plus you're taking great distributions also, but you constantly have a cash flow problem, I would rethink that for a bit, right? Build that cash balance up and give yourself a little breathing room on the business side versus pulling it all out. And then, the other option besides trimming expenses is to increase sales, right? So you could run a promo and sweep the proceeds into a separate account. There's lots of different creative ways to increase your sales for a special purpose, such as this one. All right, and what is the result? Unlike this guy, you're sleeping at night, right? Okay. All right, let's talk about, so that's cash balance. So cash flow, I'm not going to get into forecasting and some of the more advanced things, but I do just want to point out a few things because one of the big questions we get from people all the time is they're looking at their reports, right? And they're looking at the bottom line on the P&L and they go, why am I showing a profit when there's no money in the bank? So that's a big question. So there's a couple things here just to keep in mind, right? Inventory does not equal cash. So when you spend money on inventory, but you're not turning it fast enough, you're not getting the cash in the bank, right? So that's obviously an art and a science and a whole other topic about how to forecast demand for inventory. And I'm sure you guys have probably had webinars on that as well. But just remember, from the cash perspective, it does not equal cash. Accounts receivable does not equal cash. It may look on paper like you're making a profit, but if the money's still sitting out there with your customer and not with you, then it's not yours, right? I'm guessing most of you don't really have accounts receivable, unless maybe you have a service department or you're working with business accounts that you have to invoice, or you have a different line of business beyond the retail store. So this is probably not as relevant to you, but the important thing here is that if the money is out there on paper, it's not in your bank account, it's not yours yet. And so it's really important to monitor those accounts receivable days outstanding, tighten your collection procedures. What we found with a lot of our clients is they don't really like to pick up the phone and call their delinquent customers because they're afraid it'll ruin the business relationship. And I always tell them it's probably a separate department if it's a big company and they don't care. So pick up the phone. But we also partner with a couple of different companies, one on the personal side and one on the business side, who will write those letters and make those calls for you. This is pre-collections. It's just like friendly reminders on behalf of your company. So those I think are really useful when you just feel like you can't do that work yourself, or you should do it, but you just rather, you'd rather do anything else on your to-do list than pick up the phone and tell the customer that you're trying to collect on them. So, and then the third one is profit does not equal cash. So we talked about this a little bit, but you can have a paper profit without seeing the cash. There are so many reasons for that. There's super boring accounting reasons. I'm not even an accountant. I'm a business owner like you. And so I'm going to break it down in a way that you can understand, right? As an example, lots of expenses come out after the operating profit. Okay. So an example of that is loan principal payments. They do not come out of they are not included in your P&L. So if you have a business loan and you're paying payments on it, your interest expense will be in your P&L, but your principal will not. Okay. So that's going to come out afterwards and it will affect your cash flow, even though it looks like you have a profit. Owner distributions, same thing. If you're an S Corp or a partnership and you're taking distributions, that is also not in the expenses of your P&L. Those are post-operating profit. And then taxes is another one, right? There are a couple instances called pass-through entity tax where it actually is coming out of your operating expense. But for the most part, if you're paying taxes because you're a pass-through entity, it's coming out on the bottom line or below the bottom line. Okay, that was fun. Cash. You guys ready to move on to accounting? All right. I love this. I love my little fun graphics. I will actually say that, I have a team full of accountants and they actually are really fun outside the office. So I don't want to make my team feel bad because I love them and they actually have cool hobbies and everything else, but I thought this was funny anyway. All right. So here's a question. Do you want to know what almost every business owner, small business owner, what their dirty little secret is?
I do. Yes. I'm with you.
So most of them don't know how to read financial reports.
I'm surprised how often I hear that. Yes.
Yeah, it's and a lot of times it's almost they're kind of on a spectrum from what I've seen. They either really don't care at all and they're never going to get in there and look, or it's kind of shameful. Like, I know I should know how to do this because I own a business, but I really don't understand what I'm looking at, right?
That latter one is what I hear most often. Mm-hmm.
Yeah. And so for us, the reason we push this so much, and we call it know your numbers, and we literally call our reports know your numbers. We think that you don't actually have to do the bookkeeping yourself. And in fact, we recommend you don't. There's a lot of reasons for that, but a couple of them being you probably have higher leverage ways to spend your time growing your business. And number two, because most small business owners who don't know how to read the reports really don't know how to reconcile their accounts and make everything match and have a healthy balance sheet either. Now, that's not to say none of you don't know how to do this. And some of our clients, they do their books as a hobby, like it's fun for them. But if you don't fall into that category and you don't want to be sitting there at 9 p.m. on a Thursday night, I'd recommend that you instead focus your time on being able to read and understand your reports. And why do you need to do that? Because you should be able to show, or you should be able to know what's happening seasonally. You should be able to look at profitability by product or service. You should be able to look at your balance sheet and understand whether your business is healthy. Going back to the accounts receivable and accounts payable, you should know who owes you what and whom you owe, right? Okay, so this is where we get into the different levels of, this is kind of like your how you grow through the process of learning how to read financial reports, right? The first thing you need to do, level one, is you should look at your reports at least every month. Like I said earlier, those successful businesses that do it weekly, that's, weekly is great too, if you can swing it. But at least every month, and understand how you performed. You should have your expenses categorized correctly for tax purposes. You'd be surprised how many times people don't understand the tax implications of where they're putting transactions, or they don't categorize them at all. And at the end of the year, it's a big jumble and they can't remember. And when you can't remember, then we can't take a tax deduction on it. Your accounts should all be reconciled. I think a lot of people don't understand why that's important, but like, for example, when our bookkeeping team reconciles accounts, we're making sure that all the transactions that the bank says happened are also recorded properly in QuickBooks. Same with the credit cards, same with any loans, same with payroll. And if there's a problem, then we can bring it up and say, hey, there's a discrepancy here, and then we can fix it. And it could be that something was double counted in QuickBooks and your numbers are off. And it could be that you messed up a payroll and you've got to go back and fix that, right? So there's lots of reasons to reconcile accounts. I think people don't necessarily understand why that's important, but it totally is. And then your chart of accounts should be clean and standardized for your industry, and it should be set up to take advantage of tax deductions and help you know your numbers. Heather, do you want to chime in on this? Because I know we've been talking about a standardized chart of accounts for NBDA.
Yeah, so the MBDA has provided our members in our member resource area example of a standardized chart of accounts that we believe would be helpful to you to consider using. What we did was we took the feedback from all of our P2 group retailers and prepared something that really helped you itemize your revenue on the top part and then your expenses on the bottom. So we recommend you download that example that is found on the member resources site, and then provide that to your accountant or bookkeeper and get their feedback if that'll work for you. I know everyone handles their books differently, but we wanted to make sure we had a tool that was useful for you. Gretchen, thank you for letting me suggest that.
Yeah, I think it's great. So I was telling Heather that my firm belongs to an industry association as well. And we also have a standard chart of accounts, and we use that to make comparatives so we can understand and benchmark our firms against other firms. And that only floats the boats higher, right?
Exactly. Yep.
All right, so that's level one, is just read your reports. I guarantee that if you did that every week for a year, you know way more than you do now, because just looking at stuff, you will start to uncover patterns and things will start to kind of gel with you, and you'll be able to ask your accountant questions and try to figure out what's going on, right? So that's a starting point. And then level two is where, now you have a handle on kind of what's in there, and now you can start doing comparatives, right? You can compare your performance across periods, whether it's like this quarter versus last quarter, or it could be last quarter versus the quarter a year ago. You can do year to date and then last year's to date, right? So that's across periods. You can do it across product or service groups, depending again on how your chart of accounts and everything is set up, or your classes in QuickBooks. But, maybe you want to understand, is it used bikes or new bikes that are bringing in the most revenue, and then which one is bringing in the most gross profit, right? And then industry KPIs. So again, being able to compare yourself with other people in the industry and benchmark against them is, again, that just floats the boats, right? So if your profit margin is 5% and you find out the industry standard is 10, don't settle for 5, right? Get your profit up there. So having that knowledge about just, first about your own finances and your own patterns, and then comparing to others it's what's going to help you grow. All right, third, now we get into the growth, right? So you have the knowledge, and so now you can use these growth levers to move the needle on revenue, gross margin, and profit. So here's an example. I think I just said this, but like, let's say you realize that used bikes have the biggest margin, but new bikes, there's like 4 times the revenue, right? So what decision are you going to make based on that? Random retail items take up 20% of your retail space, but they hardly bring anything in revenue, and you're actually losing profit on them. What decision are you going to make about that? And how would you know that otherwise? Because it's cute little stuff that you like having in your shop, and the customers like it too, right? But you're running a business, so you have to make some hard decisions. Another example, let's say your expenses are 50% higher as a ratio to revenue in the off season. So maybe you need to think about, how do we reduce the year-round full-time labor? Maybe that's not necessary to have as many people in the shop during this time of the year. And then finally, now we get into predictive, right? So predictive analytics, forecasting revenue and growth. This is a little more sophisticated. We typically start working with companies where they really start feeling this pain point is somewhere between $2 and $3 million, where they're trying to grow quicker and they just need forecasting in order to be able to do that. And so now we're going from looking at the past and making decisions on it to looking forward at making decisions, right? All right. So that's accounting. Thanks for sticking with me on that. Now we're going to get to another super fun topic, which is taxes.
Gretchen, one question came in, just examples where expenses are miscategorized and that results in more tax liability.
So it's less about them being well, that's not true. We've had a couple instances this past tax year, as an example, where an owner paid taxes that should have been deductible because it was the state pass-through tax, but it got recorded as an owner distribution. And then they were, and some people don't even realize what they paid in. So they'll be like, oh, we didn't pay anything in. So they don't even realize they're missing that deduction, right? Another example would be if you let your books get really behind. So we have a couple people now where we're cleaning up their 2023 books, and we're trying to ask them questions. We dump all that stuff in a folder called Ask My Accountant. And then we go, hey, in March of 2023, what was this PayPal thing you did? And they're like, I don't know, right? And then on the income side as well. And so if we can't figure out how to classify it, we can't just dump everything into office supplies, right? And so we may just have to take some of the stuff as an owner distribution because we can't justify it. And if the IRS goes, hey, what is all this stuff? Can you back this up? Nobody can back it up. The client doesn't remember what it was or where it came from. So, on that note, I think that, the bottom line there is keep your books up to date, because it's a lot easier to remember what you spent the last month than it is like a year ago or 6 months ago.
Excellent. Thank you. Great question, Neil. Thank you for asking that.
Yeah, that is a great question. Okay, so taxes. I love this meme too. I hope y'all like it. Okay, so I think of taxes as kind of a quadrant, right? And so there's business and individual, and then there's short-term strategy and long-term strategy. We're going to talk about short and long-term. I don't know how all of you are set up, but a lot of small business owners are set up as a partnership or an S Corp, which means it's pass-through income, or an LLC, which is right on your individual returns. So in some ways, a lot of that is commingled. We usually have fewer C corporations at the small business level, although there are always some, right? And in that case, they are separate. But for the most part, most of you, I'm guessing, without knowing you, your business taxes flow through to your personal return. Your business profit does, and you're taxed at the personal level. So what we're going to talk about is short versus long-term tax strategy. So short-term is really more of your tax accountant, and then long-term is really your financial advisor, right? So short-term would include things like annual planning. So you may have questions like, should I buy this piece of equipment, or should I fully fund my retirement account this year? What are the tax savings if I do that? But then there's the cash outlay for both of those, right? You know, should I have a kid? No, just kidding. You should not base that decision on tax. Quarterly projections, so you know what your estimated payment should be. Changing tax code, it's constantly changing to kind of an exhausting level, and we'll see what happens with the election because it'll probably change again. Tax credits. So those are all things you're working with your tax advisor on sort of a quarterly or an annual basis, and maybe a couple years out, right? And then long-term is really more your financial advisor, and they, you know, we actually work with a lot of financial advisors on sort of like, they'll do a long-term retirement planning strategy, and then we'll execute it on the tax side, right? So estate planning, retirement planning, charitable gifts, tax loss harvesting, all that stuff. But I would say, you know, my advice to you when it comes to taxes is, what we see with our clients is that our most successful small business owners focus their time maximizing profit, reinvesting in growth, and taking advantage of reasonable but powerful tax strategies. And what I mean by that is, there's a lot of stuff on the internet. We call it TikTok tax, you know, but it's like you're on TikTok or Instagram and there's some guru saying, you know, did you know that you can buy a $5,000 handbag and claim it as luggage? And it's just stuff like that. And we get requests like that every so often, and people want to do tax tricks, and some of them are a little gray area, right? And I'm not saying don't take advantage of every deduction that you can, but what I am saying is that our most successful business owners are like, hey, I'm out there to make money. The more money I make, the more tax I'm going to have to pay. I understand that. And I rely on you as my tax advisor to come to me with the strategies I need to save the most amount of money without me having to do backflips or document every move I make, right? Mm-hmm. So that's kind of where we land in terms of what we think is the best way to do things. That said, like, if you have oodles of time on your hands, it's kind of like, if, you know, if you're working, maybe you don't clip coupons, and maybe if you stay at home and you have time, you clip coupons, right? It's a little bit like that. So a couple examples that I think of as easy but powerful. I've mentioned a couple times the pass-through entity tax. So a lot of states now are offering this, and basically it allows your business to pay the state taxes. And then that comes through on your personal return as a deduction. And, you know, depending on how much you're making and what your tax bracket is, this can add up to thousands of dollars in savings. And it literally is just paying 4 times a year. So super simple on your part, but it saves you thousands of dollars. Another example is if you're buying a large piece of equipment or a vehicle or something like that, looking at how to time the depreciation so you can take advantage of the most tax credits in the current year and balance out, you know, what you've made in a profit and how you should spread that out. In some cases, it's a great idea just to take it all up front. And in some cases, you want to spread it out a little bit more, because in the end, you'll save more in taxes. So that's another example that you're not scratching your brain trying to do it. You're not documenting every single move you've made and doing tons of internet research on, you know, your tax stuff. You're just letting your accountant deal with that for you. And then the third big example, I think, is entity structuring. So, you know, if you're an LLC, at some point, it does make sense to convert to an S corporation for extra tax savings. And so those are the kinds of things where I was looking at the cost benefits of different tax strategies and recommending them if they make sense. That was a quick one on tax, but let's move on to some of the more long-term stuff. So exit strategy. Oops, thought I moved this. Okay. All right. So this is a long-term thing, because you can't build a business others want to buy overnight, right? It takes time. If we get a 5-year notice, we like that, because 5 years is a lot of time where you can move the needle on things. How many of you feel like this graphic looks familiar? Have you ever taken your laptop on vacation? Run your quick payroll on vacation? Yeah, all those things. All right, so what is your business worth? Most owners have a number in their head, but they're not really sure how much it's worth. And, you know, sometimes they're in for a rude awakening because they figure out that the market does not think their baby is as cute as they think their baby is. So I think the biggest reason for that is the first thing we'll talk about here is that you are the business, and there's a ton of risk to that, right? So if we boil down what we're about to talk about, it's taking yourself out of the day-to-day, putting good processes in place, and having a good handle on your business finances. Those are like literally the top 3 levers for increasing your business value. But here's all 10 levers, but they do really sort of bulk up into what I just talked about. The first 3 is about getting yourself out of the business, right? So LT means leadership team. So leadership team is running the day-to-day. You're not neck deep in the weeds all day. Marketing and delivery without the face of the founder. So that means your face isn't on all the Facebook ads. And it means that you're not the one running the register all day in the sales floor. You have staff for that, right? And the reason that's so attractive to buyers is because they know, a buyer can come in and they have the choice whether they need to be in themselves or if they can hire somebody to be in and run the business, right? So if you do it all and all the knowledge is here, there's a huge risk factor if you try to sell. On the marketing side, multiple reliable acquisition channels. So this means, if like 90% of your revenue comes in because of your Facebook advertising and then Facebook changes its algorithm, that's a big problem, right? So this is the eggs in one basket problem. Reliable recurring revenue, similar. I think that there's probably less opportunity in this industry for recurring revenue, so it's not as relevant, but it may be something like service contracts or I don't know, if you have a tangential club business or something like that, right? That's very attractive to buyers. They love recurring revenue. Diverse customer base. This is the eggs in the basket. The rule of thumb here is that you don't want more than 20% of your revenue coming from a single customer. Again, I don't know if that's a big problem in your industry, except it possibly could be if you have business clients that are making large purchases. The next 4, the last 4, I should say, are really, that's about knowing your numbers, right? Having that handle on your business finances. Buyers love high cash, profitable, growing companies. Exit ready financials. What that means is when a buyer is doing due diligence on your business, financial due diligence, they're looking to see if the books, so like if your QuickBooks reports and your bank statements and credit card statements and your tax return match. And if they don't agree, then they will be suspicious that somebody is cooking the books or they're not clean and therefore they're unreliable, right? So it's really easy. You can do anything you want in QuickBooks, but if it doesn't match the reality from your bank or from your point of sale system or from your tax return, then they become suspicious that, this isn't really what you're saying it is. We don't actually know if the profit is what you're saying it is. And therefore it's either less valuable or it's not valuable at all. 5 million in EBITDA, that's probably out of reach for most small businesses. But the reason that is on the list is because most businesses under that are worth roughly 2 to 4 times the profit. So we're just gonna say EBITDA's profit, just to make it simple, right? And so if you have $100,000 in profit every year, it's worth somewhere between 200 and 400,000, depending on how well it's run and some of these other items here, right? When you get into the big leagues, the multiple changes. So now instead of 2 to 4x, it's like 9 to 10x or something like that, depending on the industry. And so now it's, instead of it being worth 4x, it's worth 10 times. So it's an exponential multiple. Getting to 5 million in EBITDA or profit probably requires multiple locations and something of an empire, but that's how you cash out. Okay, so that's business value, quick and dirty. And then the last one is financial planning. So if you're through this whole course, right? And so you've tamed the cash flow monster, you've learned to read your reports and take intelligent action from them. You're growing your company, you've dialed in your tax strategy, and you're on the road to creating an exit-ready business. That probably means you're swimming in profits, and now you have a new problem, which is, what do I do with all this cash, right? So this is a really good place to be, right? This is where you have options, unlike this guy. I'm sorry, I keep laughing at my own graphics. So one option is to reinvest in the business. And obviously, your business, if you think about the return on investment, it's probably the best ROI you can get, right? Versus something like the stock market or your retirement account or whatever. It's also the most risky. And going back to the eggs in the basket thing, you got to figure out like how many eggs do I want in this particular basket? I can't remember the exact number, but it's something like over 90% of business owners have the majority of their wealth completely tied up in their business, right? So that's pretty risky. Like if you don't have a plan outside of that, a 401k, investments elsewhere, that's pretty risky. But that is one option. Reinvest in the business into organic growth. The second option is business acquisition. So you can grow inorganically by, buying a new shop or adding on or whatever you want to do. Investing outside of the business. So back to spreading the eggs around, right? So, stock market, gold, whatever you want to do, real estate, crypto. And then finally, this is something that we really try to underscore at Red Bike, which is that you as a business owner, number one, should be paying yourself a fair market wage. And number two, you should be earning a profit and you deserve that. You've taken on this risk. You work harder than anybody. You're the one lying awake at night at 2 a.m. wondering if you're going to make payroll. And so when you do get to the point that you are swimming in profits and you have this new problem, what do I do with all this cash? Do something for yourself. You totally deserve it. In terms of who helps you with all this, it's kind of a dream team of your business finance advisor, your personal finance advisor, your tax advisor, and your attorney, right? Helping you go through all the implications of all these decisions, and they can get really complex. So you're kind of relying on them to help you twist the dials to maximize the benefits for you. All right, so we covered 5 big meaty topics in a short period of time. I think we've got just about 10 minutes. So I'll tell you a little bit about Red Bike Advisors. As Heather said, we've recently partnered with the National Bicycle Dealers Association. Super happy to be on board with you all. We're based in Wilmington, North Carolina, which is on the coast of North Carolina. But we do serve small business owners all over the US, and we have team members all over as well. And, we're really on a mission to equip clients with finance and tax insights that create exponential value. The way we like to think of it is, I think a business owner is the epicenter of an ecosystem, right? And so it's their company and their customers, their employees, their vendors, their families. And so that's that ecosystem. And, we like to plug into that and help you create value, right? So when we say we want to empower our clients to grow their businesses and ultimately their generational wealth, that's exactly what we're talking about. In terms of how we do that, so we have a stake in the ground. We really focus on fixed monthly pricing. It's tailored to your business and your level of complexity. We think of ourselves as your year-round partner, so we're an extended part of the team. We're on deck if you need stuff, which goes to proactive communications. We do have a 24-hour response KPI. We just did get through tax season, so all of us are a little behind because that ended yesterday, but for the most part, you don't fall into a black hole with us. And then at a high level, our services, we do accounting and tax and advisory on the proactive side. If you're thinking of buying or selling, we do financial due diligence, tax due diligence, entity structuring, helping structure the assets in the sale so they're tax advantageous to the buyer or seller, whichever one you are. And then for those not so fun times, when you're embroiled in some kind of a dispute, we also do forensic accounting. And so we do those for divorces, business disputes, insurance claims. This becomes more high stakes for business owners, obviously, if you're dealing with a partner dispute or, a divorce, that you need somebody on your side, like who really understands those numbers and can dig in with you on that and testify. So not to end that on a sad note, let's go to Q&A. Anything coming up, Heather?
All right, so let's see. No questions at this point. I thought the 5 topics that you covered were really insightful and definitely ones that we stress that retailers focus on. If our attendees have any questions, please place them in chat now. We do have Gretchen's contact on the screen there. So you see the phone number and her direct email address along with the website link. Well, Gretchen, looks like there's no questions coming in at this point. So either you were really thorough or people are like, all right, I got this, and they're feeling comfortable. Or maybe a little uncomfortable to ask the question on the webinar. So if you're uncomfortable, please do reach out to Gretchen or myself and I can connect you with Gretchen.
Yeah. Yeah, please do. I'd love to hear from any of you. You've got my email there. That phone number does go to our office, so you can look at our website, redbikeadvisors.com, and see what our offerings are.
Gretchen, you have a couple questions that just came in. So
Okay.
we have a moment here. Any specific recommendations for key performance indicators to track?
This is like my favorite topic. I could spend an hour on it, but from a financial perspective, I think the highest level is you can't. So in terms of KPIs, you're really looking at percentages on the finance side, right? So you can't compare $1 million in revenue to $5 million, right? But what you can compare are percentages. So you can compare the cost of goods sold percentage, the gross margin percentage, which is the flip of that, the operating profit, right? So the net profit, operating expenses as well. So those are kind of the big four buckets. You can break those out from there, like I said, into different departments or product or service lines, locations. There's all kinds of ways to split that out. So that's the finance side. And then we could get into a whole other topic because I have a marketing background. And so there's lots of sales and marketing KPIs that are super important as well. And then on the production, or sorry, not the production, but the operations side, there's some really good ones that will actually boost your finances, just like the sales and marketing ones will, around inventory turns and things like that. So I think, from the financial perspective, those ones you want to look at are those percentages of gross margin, COGS, operating expenses, net profit, and then layer in from there.
Those are exactly the ones that we track in our P2 programs. So Back Alley Bikes, I can touch base with you if you want to send me an email at Heather@MBDA. I can give you those key metrics that we do track. And then the other question was, do you have a spreadsheet that provides a starting point for cash flow forecasting? There is one in the member resources for MBDA, but Gretchen, do you have
Yeah, I'd recommend your member resources one because it's probably tailored to this industry. So yeah, jump in there and grab that. We for our clients that we do cash flow forecasting, we use fancy software, but it's not necessary, honestly. Like I actually don't use the software to do my forecasting. I use a spreadsheet as well. And it's really as simple as trying to get your crystal ball out and figure out what your revenue and expenses are going to be over the next 3 to 6 months, right? It's really not rocket science.
Exactly. Yeah. And we do, as I said, have that form available to you in the member resources. And I'm always a resource to help you work through that. Excellent. Gretchen, thank you so much.
Thank you, Heather. It was great to be here. Appreciate all of you hanging in there.
I loved your memes too. I thought they were great. So, so members, please do reach out to Gretchen if you have additional questions. She's absolutely fantastic, and her team will have your best interest in mind. All right. Have a nice afternoon, everyone. Thank you so much.
Thanks, everyone.